Well, joining us now is Tim Evans from Longleaf Trading Group. He joins us live from the CME in Chicago. Tim, hello to you. Certainly, we have seen this bounce higher in both the energy plays and also naturally the oil price. We're just 10 days out now from that crucial OPEC meeting in Vienna. How do you see this area trading over that coming period?
Hey, Natalie, nice to be with you today. Yeah, I mean, my expectation here over the next 10 days, I think it's going to be very difficult for the market to find, any kind of dynamic move, whether that be up or down. Given the announcement, obviously, I'd say the side is in favor of the bulls here to start this week. But, obviously, it doesn't ensure that anything's ultimately going to be done. And doubt of whether it will and doubt, even if it does, will it be effective, are still going to hang over the market. So I think that should spell, higher levels of volatility here over the next, 10 days, as we approach that day to see what comes out of that meeting in Vienna.
But with that in mind, certainly we are seeing, Saudi as the world's largest producer, Russia as the world's biggest exporter, even Russia is the world's largest producer. The fact that they are on board with this, the fact that they're suggesting that we do need those cuts to move through into 2018, I mean, all signs are pointing pretty positive, Tim.
Yeah, I mean, having Russia and Saudi Arabia come together in kind of a joint announcement to make those statements, I mean, is definitely helpful. I think the broader market more or less already kind of expected there to be a big push and effort from the largest exporter and the largest producer to get that production cut extended. But I think the real value of the announcement is not really for market participants necessarily, but I think it's for the other members that were part of this deal. I think they're definitely going to be applying pressure here on the other members to continue to be a part of this extension beyond the June, into March 2018, as they're ultimately going to be trying to get it pushed towards. So I think it's more of a political effort within the organization and non-members that were part of this to begin moving this along.
But we also have this question of, even if we do see that cut continuing into 2018, Tim, will this be enough to balance the market?
I'll tell you, that's a good question. I mean, I was surprised. I mean, I thought that ultimately what they would change would be the size of the cut, not necessarily the time. Because I think a lot of the doubt has been in the fact that if you just do the math, and I know we've talked about it for a number of weeks. I mean, when we do the math at Longleaf, we never saw the market coming to balance in the time frames that were being suggested by OPEC. We thought it would have required a much deeper cut, or at least marginally deeper than the 1.8 million barrels a day, which is the current deal, and what they're proposing this extension will be. I think it really just boils down to, the response again from U.S. shale. How are they able to continue to ramp up production? If they're able to continue producing and growing the rate of production at the rate they have, it's still going to be very difficult, in my view, to come to balance in 2017, and that very well could be, why they propose to push it to March. So people like myself and other market participants and analysts, who are doubtful that the market can come to balance in that 6-month time frame, will allow the extra 3 months in order to do so.
One of the items that you flagged in your note on this, Tim, is the greater clarity needed surrounding export numbers and export reporting. I'd love to just get your take on what you mean by this.
Well, there was a lot of concern, when we were looking at export levels from participating members of this deal, that we were seeing an increase in exports virtually across the board. And the exports are how global supplies are raised, especially in industrialized nations like the United States, for example. Where does the glut come from? It's not just from domestic production, but it's also from foreign imports. And the market became very concerned. You saw kind of part of the market concerned with, were they actually complying? If they're exporting at the rate that are being reported, how are these numbers even adding up where there's that much oil to export? But if they are indeed complying, that's leading to the amount of exports that we're currently seeing, and that's obviously not going to be helpful in terms of trying to find market balance over time. So I think what will be a big ticket item at the Vienna meeting will actually be addressing the export side of the equation, where there will probably be some type of number ultimately that each member will have to abide by in order to be part of this extension.
Well, certainly we did see oil move to its highest level in more than 3 weeks. This, in turn, boosting demand for some of those oil majors. We saw Exxon, we saw Chevron moving higher in today's trade. Who would be your pick amongst the bunch if we're looking on a stock-by-stock basis?
I would have to choose Exxon. I mean, if you look at the assets of Exxon, I think they're the most well diversified. If you look at their mergers and acquisitions activity, if you look at their exploration activity, it's a pretty well-balanced book. So if I feel that a company like Exxon, who is so well diversified, they're positioned for either scenario. Where if OPEC is not able to move forward and get this extension with the 9 months that they're looking for, or they do, I think Exxon is going to be able to handle any scenario much better than its competitors.
One of the items, in fact, that we haven't covered, and it would perhaps be remiss not to when it comes to this overall oil picture, Tim, it's also what we're seeing in terms of the U.S. rig counts also, and the U.S. side of this oil equation. Just guide us through some of the metrics that you're watching at the moment, particularly as we lead into that weekly count.
Yeah, I mean, we've obviously seen the rig count data, show increases. I mean, we've seen it for the last 17 weeks. I mean, last week increased horizontal rigs by another 9. I think that takes us to a total of 217, and I mean that's the highest we've seen since April of 2015. What you can see in the data, though, is while that number is increasing week over week, the rate of increases, it's not able to hold the same rate of increase. So, what's interesting is that while these lower prices, some of the lower cost producers are able to continue to ramp up production. If you take like the Permian Basin region, for example, the estimated cost per barrel is about $36. So, they can handle, the lower prices of crude, but all producers can't produce at that cost. Some are, the marginal cost is higher. And for those, that do have higher cost of production, they're not going to be able to continue to add and add and add at these current prices. So, we've seen that rate of increase begin to slow down here as we've gotten in the mid upper 40s. So if we don't see that extension, and the price of crude oil, we don't see a rally beyond 50 upper to $60. I think that ultimately will impact U.S. shale. I don't think we're going to continue to see the growth in rigs. We'll probably see it come to a grinding halt where the only producers that are going to be able to be active in the market are the lower cost producers.
Currently seeing Brent trading at $51.74, so up by, in fact, almost 1%. Tim, always great to have you with us. Thank you so much.
Have a good day. Thanks, Natalie.